So, hi everybody, this is Also Hub. I'm Giacomo, and today I'm going to analyze Standard & Poor's. This is one of the stocks that you asked me to analyze, and we'll see if there's some value into S&P. Before we get into the video, two disclaimers. First, this is not financial advice, do your own research. And second, I've used the data coming from Seeking Alpha and the New York University for the risk premium and so on. So let's start with the video. So first off, we try to estimate the weighted average cost of capital for Standard & Poor's. So I've taken the interest rate swap for the next 10 years on a US dollar as a reference. And then I've taken the risk premium from the spreadsheets of Aswat Damodaran that I think could be a great reference for this analysis. And the risk premium for the US was 4.6% for this year. And yeah, and I've taken the last 24 months beta for Standard & Poor's, the data that I found on Seeking Alpha. Next, and here we can see the cost of equity, the estimate of the cost of equity. Then we got the cost of debt. Here we see the interest rate swap as well and the bank spread. Here we see that here's my estimate for the cost of debt, given that it's a strong company, very strong, basically part of a duopoly with Moody's and a pretty low debt to capital ratio. So very manageable. And yeah, so here's the weighted average cost of capital for now, and I've made a few estimates of how it could develop going forward, both because it's expected for the rates to go down, and Standard & Poor's could benefit either both from the lowering of the interest rate and relying more on debt than equity, given that it's cheaper. So here's my estimates. Here's some highlights from the last 10 years for Standard & Poor's. Pretty good company, solid. It has shown a pretty steady growth. So yeah, we can see how it has developed. And yeah, here's the earnings. We can see that it has developed pretty well. And here's the free cash flow. So here's the assumptions that I've made for the future. I expect Standard & Poor's to deliver very well because it's a strong company. As I said, part of de facto duopoly along with Moody's. Its business is mainly ratings, and then it has very good databases for the financial services such as S&P CapIQ that I think is pretty well known among the economics and finance students and all the professionals in this field. I've used it personally, S&P CapIQ, and it's a really, really good product. It competes with FactSet, Morningstar, London Stock Exchange Group, and Bloomberg. It is cheaper than Bloomberg and Refinitiv, but it's still really, really good product and very much used by this industry. If we see this figure, for example, if we cut out some of the bad years and we start off by 2016, we can see that the growth has been a little bit different, and I think that given that yes, the rates will go down, it will benefit the weighted average cost of capital, but probably also more companies in a lower interest rate environment will issue probably more debt, and as a consequence they will need either Standard & Poor's or Moody's or both to put a rating on their debt. So I think that S&P could grow even more, but it's better to stay conservative with the estimates. Another thing, so I've taken pretty much an estimate of a growth in free cash flow of around 12% for the next 2.5 years. So yeah, and then going forward, I've used 8% in order to stay conservative, and as a long-term perpetual growth, I've used 3.2%, because yes, it is I tend to put it around the expected growth of the GDP in order to stay conservative. I've done it slightly more than that because debt and debt issuance is expected to grow more and more. For example, the sovereign debts all over the world are growing, and more companies will probably access the capital markets around the world as some emerging markets get more developed, and they will rely more on rating agencies. Some countries have tried to establish their own rating agencies, but with little to no success. China has tried to do so, France, and so on, but pretty much is a duopoly. There's also Fitch, but it doesn't have the same recognition that S&P and Moody's have. So yeah, I've done it slightly more than the 3% that is widely used. We can put it even a little bit more because of what I've just said, and see what it's like. So here's the net debt position that S&P has, the outstanding options, the exercise price, the weighted average exercise price, the value of those options, and also the restricted stock units and performance stock units given to the management as a reward. So yeah, so here we come up with the value of equity, and we divide it by the outstanding shares, and we can find the value per share that I found to be around $560 compared to the $490 that the stock is trading at right now. So yeah, here's the valuation. We can change a few assumptions. What happens if the company were to grow at 13 and we increase it by 0.05, half a point over here, and we can see how it develops. It becomes around almost 20% higher than the current share price, and yeah, so here's how this valuation changes. I think that it's fair to say that the weighted average cost of capital will go down. We can make a few assumptions. If, for example, it were not to go down as we would have liked, and we can see how the estimate changes. It goes a little bit lower. Here's 555, but yeah, I'm personally bullish on S&P because even when they got things extremely wrong, like in the financial crisis of 2007, 2008, basically there was no way around these rating agencies because it's a duopoly. Buyers of debt, like mutual funds, pension funds, and so on, need to invest in debt that is rated by a rating agency. So there's basically no way around these two companies. So a very strong moat. And I'm also bullish on the database business because basically when companies structure their workflow around a specific software and so on, there's basically no way around that software. So it's very time consuming, expensive, and so on to train your employees to use a specific database, so it's not really a go-to thing to just cut on the expense of these databases when times are bad. Probably companies like in the financial sector would rather cut marketing and other stuff, but they can't really work around these databases because they needed to trade to analyze their assets on their balance sheets and so on. So there's basically no way around these databases. So they can change database, but it's not that easy because once an analyst is used to work on a specific database, it's hard to not use it anymore and not have it. So yeah, it's a pretty strong moat, and yeah, it has happened in the past that some companies try to cut on expenses on these databases. I think JP Morgan a few years ago decided to cut on some Bloomberg terminals. It has tried to save some money by not giving licenses to some employees that didn't necessarily need it. But yeah, I think that S&P pretty much you can't really work around these databases. So I'm pretty bullish on the rating business and on the database business for S&P, and it is in a de facto duopoly with Moody's, so I'm pretty bullish on the stock. I really like the business, and yeah. So here's the valuation that I've come up with. It is not even it is relatively conservative. We can see if we even get it even lower than this, but yeah, I'm still bullish on the stock. I'm bullish and I really like the stock. So here's my point. Let me know in the comments if you like this type of analysis, if you would do anything differently compared to what I've done. Make sure to comment with the stocks you would like me to analyze. So this is it for today. I'm Giacomo. This is Hustle Hub. See you next time.